Stocks are down sharply here into the close. Just show you what's happening right now. Low of the day was down 928 on the Dow. We're down a little more than 700 points, 800 points now, 833 right now. Ben Emons joins us, Medley Advisors, Managing Director of Global Macro Strategy. It's felt painful pretty much all day, Ben, whether it's the hangover from the Fed, the surprise, I would say shock announcement from the Swiss National Bank. What are you hearing? What are you seeing as far as the selling today?
I think you summarize it, Sarah. It's definitely a worry about that central banks have to tighten a lot more than was thought. I think what the Fed yesterday revealed was such a steep path of rate hikes ahead of us, plus the ambiguity how high the Fed funds actually may have to end up. That wasn't really clearly answered when Steve Leisman asked about that. So coming into today, getting a surprise from the Swiss Central Bank of a country that's been in deflation for so long, they too come off the sidelines. Tonight we're getting the Bank of Japan. They may not do anything, but there's focus there too of eventually getting out of that policy. So it just all adds to the uncertainty about what monetary policy is going to do from here, how high have rates to go up. And then we're in an environment of then slowing growth with sticky inflation. So I think the market embraces more and more the view this is really a stagflationary environment, and that makes a lot of asset classes struggle, no matter what the fundamental backdrop of those asset classes is.
What if anything, works in this stagflationary environment?
Yeah, you and I have been talked a lot about this over the last several months, right? You can stay offense to an extent, although listening to your previous conversation, the airlines clearly is the trade, not anymore, right? That has, I think, faded.
You've loved it, so you're giving up on it?
I have taken profit, yeah, because the fuel hedge is an issue, and that's, I think, really biting in. Plus, you do deal with airline inflation. I think consumers are picking up on. So there's going to be a saturation of demand there. But you can stay in these high cash flow generating companies. They say, take cows as the broad ETF for that. There's a lot of energy companies in there. Also a lot of technology type companies that, yes, they get affected by the market, but they're pretty stable in their balance sheet and cash flows. I think that's one way to do it. On the other hand, you're going to sit on the sidelines. You can't really engage here much until we're getting a better sense of the direction of policy. And that's pretty difficult at this moment.
Well, two things I just want to note. What makes today's sell-off a little different flavor-wise than what we've seen lately, which is Treasury yields are lower. So there's buying of bonds. They're working today as a safe haven, as an alternative. And the dollar's weaker. And both of those things have been part of the tightening of financial conditions and the higher interest rate story that have pressured stocks. So what does that tell you? That we moved on to the slowdown?
There's definitely a slowdown story building in Treasuries. That I would concur. Because if you do have to raise rates with that much, then it's going to slow down the economy. The housing data today showed it clearly. That's where high rates are really impacting activity. So I think that's one reason. But is it all out clear to be in Treasuries? No, because until we have truly slayed inflation really down or materially down, I don't think it's an all-out buy. The dollar, I think, was affected by the Swiss Central Bank's surprise. I still think the dollar has a lot of upside because the Fed has to fulfill this tightening path. It cannot back away from that tightening path. So the dollar will continue to benefit from a widening interest rate differential to other countries.
Yep, which hurts stocks and earnings. Ben, thank you. Ben Emons.